If you haven't heard about Anchor, it is the easiest way to make a podcast. Let me explain. It is free. There are creation tools that allow you to record and edit your podcast right from your phone or computer. Anchor will distribute your podcast for you so it can heard on Spotify, Apple Podcasts, and many more. You can make money from your podcast with no minimum listenership. It is everything you need to make a podcast and in one place. So please download the free Anchor app or go to anchor.fm to get started. Welcome to Rigel Insights Podcast Show, and I am Deb, the host of Rigel Insights Podcast Show. Every Tuesday, I will bring you an episode containing some interesting subject or topic which I like or enjoy talking about. This can be from marketing, investment, real estate, technology, global nomad, lifestyle, business, and country economy, travel, and anything I like to talk about or research about and want to show or share to the world.
Welcome to a new episode of the Rigel Insights Podcast Show. Today we are going to discuss American corporation profit income in foreign bank for tax shelters profit and solutions management research publication series researched and written by Deb Bandyopadhyay. A tax haven is generally an offshore country that offers foreign individuals and businesses little or no tax liability in a politically and economically static environment. Key takeaways: tax havens provide the advantage of little or no tax liability. Offshore countries with little or no tax liabilities for foreign individuals and businesses are generally some of the most popular tax havens. Investors and businesses may be able to lower their taxes by taking advantage of tax-advantaged opportunities offered by tax havens. However, entities should ensure they are compliant with all relevant tax laws. Understanding tax havens also share limited or no financial information with foreign tax authorities. Tax havens do not typically require residency or business presence for individuals and businesses to benefit from their tax policies. International tax havens: in some cases, international locations may also be identified as tax havens if they have special tax laws. For example, in the United States, Alaska, Florida, Nevada, New Hampshire, South Dakota, Tennessee, Texas, Washington, and Wyoming require no state income tax. Offshore tax havens: offshore tax havens benefit from the capital their countries draw into the economy. Funds can flow in from individuals and businesses with accounts set up at banks, financial institutions, and other investment vehicles. Individuals and corporations can potentially benefit from low or no taxes charged on income in foreign countries where loopholes, credits, or other special tax considerations may be allowed. A list of some of the most popular tax haven countries includes Andorra, the Bahamas, Belize, Bermuda, the British Virgin Islands, the Cayman Islands, the Channel Islands, the Cook Islands, the island of Jersey, Hong Kong, the Isle of Man, Mauritius, Liechtenstein, Monaco, Panama, St. Kitts, and Nevis. Characteristics of tax haven countries generally include no or low income taxes, minimal reporting of information, lack of transparency obligations, lack of local presence requirements, and marketing of tax haven vehicles. In general, this and other provisions, particularly for reinvestments, provide allowances for businesses to benefit from low or no tax rates offered in foreign countries, but businesses should closely monitor and accurately report foreign income as it pertains to U.S. tax law, generally accepted accounting principles, GAAP, and the guidelines under International Financial Reporting Standards, IFRS. Some companies that have historically been known for offshore tax haven holdings include Apple, Microsoft, Alphabet, Cisco, and Oracle. Overall, tax havens may also offer advantages in the area of credit, since it may be less expensive for U.S.-based companies to borrow funds internationally. This type of lending, which can potentially fund acquisitions and other corporate activities, is also subject to reporting within the guidelines of U.S. tax law (GAAP) and guidelines under IFRS. Individual taxpayers. The U.S. has special rules in place for the reporting of foreign income by U.S. citizens and non-U.S. citizens. These rules are generally governed under the Foreign Account Tax Compliance Act, FATCA. FATCA requires the filing of a Schedule B and/or Form 8938, which provides disclosure of foreign account holdings when investments exceed $50,000. Separately, foreign account holders may also be required to file Form 114, Report of Foreign Bank and Financial Accounts. U.S.-based companies are keeping their profits in bank accounts in other countries. Around $183 billion of stocks are piled in those countries. There was an increase of 14.4% from the previous year in the accumulation of the funds. Bloomberg studied that total of 83 companies in the USA has kept their profit earning in different low-taxed countries across the globe. A total of $1.7 trillion has been outside the USA for the purpose of tax exception. Top companies like GE, Microsoft, Johnson & Johnson, and IBM are the top companies who are keeping the money outside the country so that the USA Tax Revenue Department could not get hold of these incomes. Some of the companies are owned by foreign companies which help them to park their profit margin company's bank account. The rise of the cash flow from the low-taxed countries is due to the increased number of the customer from these areas. Google has kept $31 billion in annual filling in taxes, but of which 65.3% are in the liquid holding outside the USA. This is hampering the USA taxes and resulting in rise of different problems due to this. U.S.-based companies receive tax credits in their income from the outside country, but still they are deferring the taxes by not bringing those money back to USA. Regulatory filing asks the USA corporation to report the foreign profit, but they can defer taxes on those income. The income is not kept in the form of cash in other countries. They are using that fund to invest in the physical infrastructure and bond of that low-taxed country. Intangible assets are among one of the areas where companies are selling their patents and getting cash out of it. The low-tax jurisdiction allows them to pay low taxes. Among these, Microsoft has sold many patents to offshore countries and reported $60.8 billion in offshore holdings, whereas they paid only 3.1% in the foreign tax for this. The USA government tax system is outdated and is not compatible with other countries' tax system has been claimed by many senior executives of USA-based companies. They mentioned that for competing in the foreign land they have to keep the money in those countries for the future need. Citigroup has reported that foreign tax is as low as 8%, which is far below that USA tax system rates. The USA tax is 35%, which is the high compared to any other country corporate tax rates. This not only creates the obstacle for USA government to get a hold of the income of the companies in foreign lands. Moreover, they are lagging behind among other countries in tax system due to the low tax rate of those countries. Many U.S. corporations use offshore tax havens and other accounting gimmicks to avoid paying as much as $90 billion a year in federal income taxes. A large loophole at the heart of U.S. tax law enables corporations to avoid paying taxes on foreign profits until they are brought home. Known as deferral, it provides a huge incentive to keep profits offshore as long as possible. Many corporations choose never to bring the profits home and never pay U.S. taxes on them. Deferral gives corporations enormous incentives to use accounting tricks to make it appear that profits earned here were generated in a tax haven. Profits are funneled through subsidiaries, often shell companies with few employees and little real business activity. Effectively, firms launder U.S. profits to avoid paying U.S. taxes. Loopholes used to shift U.S. profits to tax havens. U.S. firms can set up a subsidiary offshore, channel billions of dollars of profit through it and make the subsidiary disappear for U.S. tax purposes simply by checking a box on an IRS form. Corporations can sell the right to patents and licenses at a low price to an offshore subsidiary, which then licenses back to the U.S. parent at a steep price the right to sell its products in America. The goal of this transfer pricing is to make it appear that the company earns profits in tax havens but not in the U.S. Wall Street banks. Credit card companies and other corporations with large financial units can easily move U.S. profits offshore using a loophole known as the active financing exception. A U.S. corporation can do an inversion by buying a foreign firm and then claiming that the new, merged company is foreign. This lets it reincorporate in a country, often a tax haven, with a much lower tax rate. The process takes place on paper. The company doesn't move its headquarters offshore and its ownership is mostly unchanged, but it continues to enjoy the privileges of operating here while paying low tax rates in the foreign country. The simplest solution is two-and deferral, as proposed by Senator Bernie Sanders and Representative Jen Schakowsky. Corporations would pay taxes on offshore income the year it is earned, rather than indefinitely avoid paying U.S. income taxes. This would also remove incentives to shift U.S. profits to tax havens, and it would raise $600 billion over 10 years. Short of ending deferral, Congress should close the most egregious loopholes, such as check-the-box, transfer pricing, the active financing exception and corporate inversions. It should also end the loophole that lets firms deduct the cost of expenses from moving jobs and operations offshore if the profits earned from those activities remain offshore and untaxed by the U.S., saving $60 billion over 10 years. Senator Carl Levin, DME, has introduced legislation, the Stop Tax Haven Abuse Act, S. 1533, that will close some of these loopholes. It will raise $220 billion over 10 years. For today this much. I will back with another great topic to discuss next. Till then, be safe and wherever you are.